Hello and welcome to Lecture 5 in this lecture series on the subject of Principles of Insurance IC01. This lecture series is based on the syllabus of the Insurance Institute of India in 2025 and is designed to help those who would like to watch and listen to lectures to understand the subject and write the exam conducted by the Insurance Institute of India. In the last video, we dealt with the topic how insurance works and we saw the law of large numbers. Link to the previous lecture is provided in the description below. In this lecture, we will be completing the first chapter, which is the introduction to the principles of insurance, and we will be covering the benefits of insurance. Insurance is viewed at times merely as a financial obligation or a statutory requirement, but is in reality the backbone of financial stability. We are talking about the necessity and benefits of insurance. We aren't just going to look at insurance as a product that one buys. We are going to examine insurance as a strategic tool for risk management, enterprise stability, and even national growth. Let's start by looking at the individual level. Why do we actually need insurance? It really comes down to one concept: capacity. Every single one of us has a finite capacity to bear financial losses. This capacity depends on our income, our savings, and our personal risk appetite. But here's the hard truth: disaster does not care about one's capacity. Whether it is a health crisis, an accident, or the loss of a breadwinner, the financial impact of these events often far exceeds what an average family can pay out of pocket. This is where insurance steps in. It bridges the gap between limited financial capacity and the potentially unlimited cost of a disaster. Take life insurance for example. It ensures that if a family loses their primary earner, they don't also lose their financial dignity. It provides an immediate replacement of that economic capacity. Now, let's take a look at that concept and apply it to the corporate world. Just like a business faces risks: fire, flood, cyber attacks, or burglary. Without insurance, a company's balance sheet is incredibly volatile. One bad year or one warehouse fire could wipe out a decade of profits. Insurance, therefore, acts as an insulator. It stabilizes the enterprises against these external shocks. By transferring the risk to an insurer, a company ensures that its financial results remain predictable. It ensures that a physical disaster doesn't turn into a financial bankruptcy. This stability is what allows businesses to plan for the future with confidence. Moving on, there is a strictly financial argument for insurance that CFOs love: capital efficiency. Imagine for a moment that insurance didn't exist. If you ran a factory, you would have kept millions of dollars in a frozen bank account sitting idle, just in case something went wrong. That is what we call as frozen capital. It's money that isn't working for you. It's just sitting there as a safety net. Bank account is frozen not in the legal sense, but in the sense that it is earmarked for meeting out a future catastrophe. Insurance unlocks this capital. Because you have paid a premium to transfer the risk, you don't need to hoard that massive emergency fund. You can release that capital and put it into work, investing in new machinery, hiring more staff, or expanding to new markets. It turns idle reserves into active profit. This brings us to the relationship between insurance and banking. Banks and lenders are naturally risk averse. When they lend money to build a factory or buy a home, they rely on the value of that asset as collateral. But what happens if that asset itself is destroyed? The borrower goes bankrupt and the bank is left with a bad debt. Insurance is the grease in the wheels of the credit system. It encourages lending because it protects the collateral. When a bank knows that a factory is insured, they know their loan is safe even if the factory burns down. Without this protection, credit would dry up and industrial growth would grind to a halt. Sometimes, however, insurance isn't a choice, it's the law. We see this most clearly with the Motor Vehicles Act 1988. Why does the government mandate that you cannot drive a car without insurance? It isn't to protect the driver, it's to protect the public. If you cause an accident that injures someone else, you might not have the money to compensate them. Mandatory third party liability insurance ensures that the innocent victim is not left suffering without financial help. It's a matter of social responsibility enforced by legal statute. Section 146(1) of the Motor Vehicles Act 1988 mandates motor vehicle insurance at least with regard to third party damage. It says, among other things, no person shall use a motor vehicle in a public place unless there is in force a policy of insurance complying with the requirements of this chapter. There is also a severe punishment to non-compliance of this. Section 196 of the Act provides for imprisonment of 3 months or a fine of rupees 2000 or both. Beyond the law, we have rules of business. If you look at any major construction project or supply chain agreement, you will find insurance clauses deeply embedded in the contracts. Why? Because in a large project involving multiple stakeholders, everyone needs to be insulated from liability. If a contractor makes a mistake that delays the whole project, insurance ensures that the financial burden doesn't collapse the entire deal. It insulates the parties from vicarious liabilities and ensures that the project can continue smoothly despite setbacks. So far, we've talked about protection. Let's pivot slightly to life insurance, which offers a unique dual benefit: protection plus savings. Products like endowment plans or unit linked insurance plans (ULIPs) aren't just about dying, they are about living. They foster a habit of disciplined saving. By paying a regular premium, individuals are forced to put money aside, which accumulates into a substantial corpus over time. For many people, their life insurance policy is their most significant long-term savings asset, second only to their home. Now, let's zoom out to a macro level. How does insurance help the nation? Insurance companies are essentially giant reservoirs of long-term funds. They collect small premiums from millions of people and hold that money for decades. This makes them the perfect investors for long gestation projects like infrastructure. When you see a new highway, a bridge, or a power plant, there is a very high chance that insurance funds from companies like LIC are financing the development. By channeling household savings into nation building infrastructure, the insurance sector fuels the broader economy. There is also a hidden benefit to insurance: safety. Insurers don't like paying claims. Because of this, they are experts in risk assessment. They use their pricing power to incentivize safety. If a factory installs better fire sprinklers or a logistics company installs GPS trackers to prevent theft, the insurer reduces their premium. This rating mechanism pushes industries and individuals to adopt safer behavior. Over time, this reduces the total number of accidents and losses in society, which benefits everyone, not just the insurance company. Let's look at the psychological aspect. Insurance is a trade. You're trading a small, certain loss, your premium, to avoid a massive, uncertain loss in the future. This trade provides something you cannot put a price on: peace of mind. It eliminates the anxiety of what if. It replaces the fear of the unknown with the certainty of a contract. This security allows entrepreneurs to take risks and families to sleep soundly. knowing they are protected. Finally, we must acknowledge the social impact. Governments used insurance principles to provide social security to the poor and vulnerable, protecting them from falling deeper into poverty due to illness or accidents. Simultaneously, on the commercial side, insurance allows businesses to innovate. When you know your downside is protected, you are more willing to explore new technologies and new markets. It facilitates trade and keeps the wheels of commerce turning. To summarize, insurance is far more than a policy document. It safeguards our families and businesses. It frees up capital for investment. It enables the credit system and it fuels national infrastructure growth. It is a silent partner in almost every economic activity we undertake. So, we have completed the first chapter on the subject Principles of Insurance IC01. In the next video, we will discuss a set of multiple choice questions or MCQs under the first chapter. And we will also provide another set of MCQs for you to practice. Take care and stay safe. See you in the next lecture.